Hey everyone, it's Rod with the Pow Group. Welcome back on The Pursuit of Wealth, your home for MJ Stocks, crypto assets, news, and interviews. Today is Wednesday. It is May 8th. Hope you're doing well. And in this video, we're going to be discussing Canada's proposed capital gains tax changes. They're proposing that they increase from 50% to 66.7%. And we're going to discuss what all this means. There's some news out that it wasn't included in the proposed budget, and that there could be some legislation forthcoming with regards to this, and they could deal with it individually on a separate matter. But we'll discuss what all of this means. It doesn't actually mean that if you have a capital gains tax, if you have capital gain, you're not going to have to give them 66.7% of that gain. So we'll break this down in layman's terms. Before we get to it though, make sure to smash like. It helps support me in the channel. It doesn't cost you anything. If you're new, you can subscribe, tick the bell, all the good stuff. You'll be notified on any future videos or when I go live. As always, this is not financial advice, nor is it legal or tax advice. I am not a tax professional. I strongly encourage you to hire an accountant, a good accountant, if you're worried about this or if you are looking for advice for your own personal situation. You can also follow us over on X, formerly Twitter. The handle for that is @GroupPow. Going to be using that as my platform of choice going forward. So here was the Canada's law firm, BLG. They said the increasing capital gains inclusion rate. Think first, maybe act later. So much has been made of the government's decision in the 2024 federal budget to increase, and that was on April 16th, to increase the portion of capital gains that are included in income from 50% to 66 and 2/3% effective June 25th, 2024. So effectively June 24th would be the cutoff date. Starting then, for natural persons, 2/3 of capital gains realized each year above $250,000 will be included in income. Any favorably taxed stock option benefits realized will reduce the $250,000 limit. For corporations and trusts, the 2/3 inclusion rate will apply to all capital gains realized on or after June 25th, 2024. So with regards to that, it's only the 250,000 only applies to individuals. So for corporations, that will apply to all capital gains. So that's something to that's a big takeaway there. But then there was an update. That article and this news came out shortly after. It was April 26th. Shortly after the budget, there was a lot of commotion going around this, a lot of controversy, a lot of angry people, and I think it's madness. But it's currently at 50%. But then there was an article here on the Canadian Press on April 30th. Capital gains changes not included in Freeland's proposed budget legislation. So changes expected to come in separate legislation, forcing opposition to address them directly. I think it says forcing opposition. I'm sure what's going on there was a typo or not, but we'll see what happens. But as of right now, we're getting some positivity. But at the end of the day, there's probably going to be a lot of pushback with regards to this, I would imagine. But we'll go through a little bit quicker here. Right now, the government taxes 50% of capital gains or profits made from the sale of assets, including stocks and secondary properties. So if you're in Canada, and you're like me, if you've sold your primary residence, if you have a home and you live in it, and it's your primary residence, if you sell that, you don't have to pay any capital gains. And again, don't take everything that I say as, take it with a grain of salt. Go, and I highly encourage you, if you're making anywhere near $250,000, then you need to go and hire a good accountant. It's definitely worth it. It's an investment in itself. So I would highly encourage you to do that. I pay good money for my accountant, but at the end of the day, it's worth it. So Freeland is proposing to increase that to 2/3 of all capital gains realized by corporations and any amount in excess of $250,000 in 1 year for individuals. So one thing I want to let everybody know is it's not like let's say you have a $250,000 capital gain. It's not like you're paying 66.7% of that, right? It's what ends up in your taxable income for the year. So there's federal income tax rates and there's provincial and territorial income tax rates, right? So depending on your jurisdiction where you live, Quebec has different rates, New Brunswick, all these have different provincial rates. So what you have to do is add the two and figure out what your taxable income is. So for example, let's say you have $100,000 and you have a gain of $100,000. So you put in 100,000, you're at 200,000. That gives you a $100,000 gain. So that means you'd be taxed on 50% of that gain. Not like you're giving the government 50% of that. That 50%, that $50,000 would be added to your taxable income for the year. So if you work a job and you make $50,000 or $100,000 there, then your taxable income is $100,000 or $150,000. You follow? So if you have, let's say you put in $250,000, just for easy math, you put in $250,000, right? And you double your money. You're at $500,000. So in excess of $250,000, your capital gain would be $250,000. So $250,000, take out your initial investment. So you'd be taxed under this new proposed rule, 0.667. So 166 of that would be added to your taxable income for the year, and then you would times that by whatever your excess is. So on the portion, it's 33% for 2024 in Canada on the portion of taxable income over 246,752. So if in this instance, if this was all that you were making, let's say you're a full-time trader or investor, if that was all you're making, that's your income, well, you'd be in this 26% category, right? 111 to 173. But then you have to add on your provincial tax as well. And then let's say you work a job and you make 100 grand a year. So you add 100 grand. Now you're over that 246. And then let's say you have a side hustle, right, or a business or something like that, then you have to add that taxable income there as well. And that's why it's important to have receipts and write-offs and whatnot if you're a business owner, to make sure you keep your receipts and make sure you're, like I said, hiring a good accountant so you can figure out if you're working from home, things like that. There's forms that you can fill out to get money back at come tax time. So that's why I say it's very recommended to hire a good accountant and tax professional. So like I said, if you let's say your capital gains was that, and you add your annual, your job, your salary, any other income that you have, side hustles, or you sell a second property or something like that, right? All of that gets added into your taxable income. But again, it's not like they're taking 66% of your gain. If you have a $100,000 gain or $250,000 gain, they're not taking 66.7% of that. It's just 66.7 ends up in your taxable income. And then you add in all your other income from other sources of income, and then you add them all up, and that gives you your taxable income. And then depending on what that value is, you fall into these different thresholds, whether it be federal or provincial. So like I said, highly encourage you to check into an accountant. Like I said, if you're making anywhere north of, if you're making more than 100 grand, I think you should have a good accountant. But definitely, if you're making 250,000 and you're going to be in that new proposed rule, and you're making over 250,000 capital gains, it's almost a given. You need to have a good accountant. So that in itself, like I said, is an investment, and having those receipts and staying on top of it and making sure you have a good book, right? And you're keeping a good record of everything and making sure you're keeping all your receipts. So yeah, again, I'm not a tax professional. I'm not a financial advisor, but I'm just sharing what I've learned. And, I just finished doing my taxes for 2023, and I've got a lot. I've got a couple businesses, right? I've got multiple sources of income. I got my short-term rentals. I got multiple condos, long-term rentals, short-term rentals. So it's getting very, very complicated. And my dad actually does taxes as a side hustle, but he basically told me, I don't feel comfortable doing your taxes anymore. They're getting way too complicated. So, I had to go out and hire a good accountant and tax professional, and I'm glad I did, because like I said, it's taking a lot of the guesswork out. It's taking a lot of stress off my back, and quite frankly, I get a lot more return because there's things that I didn't know about, or other people who aren't well versed in it or aren't dealing with it every day may not know, right? So if this video was helpful, smash the like. I would appreciate it. Let me know your thoughts and opinions on this in the comments section. But going in it there, it's Rod with the POW Group. Thanks again for joining us in the pursuit of wealth, and we'll see you again on the next video.